Hello everyone, I'm Kunal Sodhani, your host for today from Global Trading Center, Shinhan Bank India, and we are here with another quarter of October to December 2024 with our analysis on global factors, domestic trends, and our analysis on several currency pairs. But first, let's talk about the domestic factors. So if we talk about the trade deficit numbers, we have seen trade deficit numbers to widen to a 10-month high to $29.7 billion. Now, what was the reason behind it? Imports surged to all-time high to $64.4 billion. Also, other factors to understand is we have seen a drop in shipment to China to the tune of around 22.4%. While on the other hand, the gold imports have also increased to $10 billion, which is tremendous, which is also causing concerns with the trade deficit numbers getting widened from here on. Reasons for gold increase definitely gets attributed to the festivals and reduction in custom duties. Now, what happens when this is a concern of widening trade deficit? It also raises concern on the current account deficit numbers, which now raises concerns to the tune of 1.2% of GDP for Q2 FY25. Now, let's understand flows, because flows are something which defines dollar rupee to a very large extent. So, if we talk about the pandemic since March 2020, we have seen the index, that is NSE, National Stock Exchange, NSE 50, growing more than 200%. While also if we talk about the total turnover or the market capitalization, it has grown towards $5 trillion. Now, if we break down into numbers, if we talk about 2024 FPI numbers for equity and debt, we have seen inflows to the tune of around $9 billion in equities and around $13 billion in debt for Jan to September 2024. While if we talk about 2023, we have seen inflows to the tune of $20 billion in equity, while around $8 to $9 billion in debt. So overall, since last year, we have seen healthy flows. The reasons attributed for these healthy flows, one obviously remains the political stability, major push in the manufacturing sector, which is gaining more traction, renewable energy space growing again and again, which is again a major push from the government, which have their own targets by 2030. We have seen regulatory reasons, where the policies have been to the tune of growing to the markets, while also the fiscal policies by the government has been tremendous, which also pushes the FPI flows higher. Also, if we talk about the debt flows, they have gained more traction after the Indian bonds getting included into the JPN bond index. Also with this, the widening of the interest rate differential between the US Fed and India gives more opportunity for flows to drive to India. But when we are talking about flows, we cannot ignore FDI flows, which are long-term flows. So if we talk about the net inward FDI flows, they were to the tune of $27.7 billion for April to July 2024 versus $22.4 billion a year ago. Now, these are the net inward FDI flows. But why these FDI flows were higher? What were the major contributors? Those were financial services, communication, computer, manufacturing, electricity, and many other energy sectors, which are contributing to almost 3/4 of this net FDI inflows. If we talk about net FDI flow numbers, then it is $5.5 billion for April to July 2024 versus $3.8 billion a year ago. So these were particularly flows which we discussed, which are quite crucial. They have been gaining, and India has been, if we talk about the indexes also, they are at all-time highs. Now let's understand the Forex reserves. The best part about Forex reserves is now we are trading at an all-time high with $689 billion of FX reserves with India. Two important things to understand. One, if we talk about only this year 2024, we have gained or expanded by $66 billion. If we talk about 2023, we expanded our FX reserve by $60 billion. Only during 2022, we had seen a decline by $71 billion. But all in all, two important reasons which are in favor of these higher reserves. One, we have a decent import cover of slightly higher than 12 months. Also, if we talk about the external dollar debt, this dollar debt is roughly to the tune of $663 billion, and our FX reserves are higher than these dollar debts, which is around $689 billion. So almost 103% of our FX reserves are there. It's covering the external debt for India. RBI's focus definitely remains, one, with the import cover, and secondly, to cover the external dollar debt, so which is again a part of it. Now moving towards the growth and the inflation trajectory. So if we talk about the growth figures, we have seen a 15-month low for Q1 FY25 to the tune of around roughly 6.65%. And if we talk about the GVA number is trading around 6.84% roughly. So we have seen a decline in this growth mainly because there was a decline in expenditure during the election phase. It's also important to understand the difference between the GVA and the GDP that has narrowed significantly due to the subsidies payout and also because of the downturn in terms of the net indirect taxes. Now, if we talk about the Q4 FY24 numbers, the GDP was higher than the GVA number by almost around 1.5%. But if we talk about now Q1 FY25, the GVA number has crossed the GDP number by almost around 10 basis points. If we talk about the FY25 real GDP growth number, the anticipation remains at 7.2%, and it's important to understand the growth trajectory from here on remains positive. So let's move on to the CPI number. The CPI number for the month of August came in at 3.65% versus 3.6% which was seen in July. Now this CPI number has been higher due to the elevated vegetable and pulses prices, so in turn we can see the food inflation. If we talk about the food inflation or the beverages inflation put together, we have seen a rise to 5.3% from 5.1% in July, while if we talk about the core inflation, that remains steady at around 3.4%. So considering the RBI's tolerance band of 2 to 6%, I think we are still in a comfortable band, but the pace is uneven. So I think there still remains concern with the elevated food prices. Now, if we talk about this inflation and also the monsoons, they have been faring well. And considering the Kharif sowing season, which has been good enough, the food inflation might cool off. So for the year 2025, FY25, we expect the average inflation to stay around 4.5%, and for FY26, we expect the average inflation to be around 4.1%. Now, what if we dwell after the growth numbers as well as after the CPI number? It's important to understand how our monetary policy will pan from here on, because as we have seen the Fed being aggressive in terms of their interest rate cut, it's time for RBI how do they take place or how their behavior remains with respect to the policy. So important first, the consideration remains that the focus from RBI may still remain on the domestic dynamics, considering the elevated food prices and also the household savings. So thus the focus somewhere we believe will be more on the dynamics which are more pertinent to the domestic factors. Secondly, it's important to understand the stance change, because RBI historically we have seen that first RBI looks forward to change the stance rather than going for a direct cut. So we believe that possibly in the month of October we may see a change in stance to neutral from the withdrawal of accommodation, and later possibly in the month of December we may see a 25 basis rate cut. If we talk about FY25, we can see the shallow rate cuts by around 75 basis for the year, considering the India's eminent growth and the strong macros. So this was all from the domestic perspective. So now when we talk about the global events, first important event to watch out is the US presidential elections. Now, the US presidential elections are on November 5th, but it's important to understand first Joe Biden, who was running for the presidential election, has backed out on July 21 and have endorsed Kamala Harris to take a lead for the Democratic Party. On the other hand, we have Donald Trump, who from the Republican Party, where he has been a candidate for the second term, but it's not a consecutive term for him. So he had lost in 2020 against Biden. So what's important to understand, first there are 50 states, out of which there are 538 seats, and a team or a member team has to win at least 270 seats to have a victory or majority into the parliament. It's important to understand there are swing states, or we can say battleground states, which actually creates a lot of difference in terms of the countings. Again, we had the presidential elections on September 10th between Kamala Harris and Donald Trump, where as per the polls and as per the debate, Kamala Harris still holds an upper hand at that point in time, and still she's leading as per the polls in several surveys by 2 to 4 points. So if we put it in percentage terms, around the ratio is 46 to 50, like 50 with Kamala Harris and 46 with Donald Trump on a broader basis. But these are just polls. There is still a long way to go and things may change. It's important to understand now that what happens if there are votings which are pre-voted. So if, for example, now since September 20, there is an opportunity for voters to have their votes in place way before, weeks or months before the actual election takes place. So that has been started. That has been started in 3 states: Minnesota, South Dakota, so Virginia. So these are the 3 states where again these voting has already started. If we talk about 2020, what happened there was in 2020, roughly around 2/3 of the American voters had voted via this ballot numbers much earlier than the actual voting pattern. So that was almost around 100 million American voters were there. but that was a COVID time, so may not be the same thing which happens here. If you're talking about the fiscal part, that is how the presidential elections will take place or how the results will take place, it's important to understand what happened with Fed and their policy. So we have seen that the Fed cut interest rates by 50 basis points. This is larger than the usual expected, though some portion of the market participants did expect a 50 basis cut, but still it was considered more aggressive. So now the current rate is around 4.75% to 5%. The voting pattern was 11-1 with Fed Governor Michelle Bowen. She was the only person who voted against 50 basis, so she voted for 25 basis cut. And this dissent by the Fed has been first time since 2005. It's also important to understand the projection changes. So if we talk about the GDP number, they have been revised lower to 2% from 2.1% in June. If we talk about the unemployment number, they have been raised to 4.4% from 4% in June. If we also talk about the PCE inflation number, that has been reduced to 2.3% from 2.6%. If we talk about the core PCE number, they have also been reduced lower to the extent of 2.6% from 2.8%. Also, if we talk about the Fed Fund futures rate, they have been also reduced from 5.1% to 4.4%. If we again draw this into the trajectories for 2024, there is further 50 basis rate cut expected. While if we talk about 2025, 100 basis of rate cut is expected, while for 2026, another 50 basis is expected. So this federal fund rate is being moving towards a terminal rate of 2.9% as per the expectations by the end of 2026. So this is the broader trajectory of Fed. Now what happens when we are eyeing these numbers? So we need to understand how the 10-year US Treasury yields will pan out from here on. So if we draw technical analysis, we have seen that 3.35%, considering the 50 basis cut, remains an important support zone, while now 4% to 4.2% remains toppish. Similarly, if we draw the line towards the dollar index, we have seen the recent lows of 100.20 and then a bounce from there. But if we talk about the July 14, 2023 lows, that was around 99.57. So that remains a very, very important crucial support zone at this point in time. And only if we see a break of that 99.57, then we can see levels of 97.30 testing as well. While on the other hand, if we talk about the resistance level, the near highs of 106.5 remains a very crucial resistance to watch out for. Now let's move on to the other policy side, which is the European Central Bank. So the European Central Bank did cut rates by 25 basis points. That was in line with expectations and are now at 3.5%. Usually their policy is not predetermined. They don't follow any set procedure of going for a rate cut. There was no change in the forward guidance as such, but there was a change in the growth projections. The growth projections were reduced to 0.8% from 0.9% for FY 24-25. And if we also talk about the inflation forecast, that remained unchanged. But the concerns from Christine Lagarde had always been on the services inflation, and thus monitoring on that part is quite important. But also if we see what are the market participants expecting for the month of October, there are around 35% of the market participants still expecting another rate cut, considering the aggressiveness of Fed in the next month, that is October as well. Now if we draw the line for euro-dollar pair in our anticipation, the euro-dollar pair finds a very strong support at 1.0650 levels, while the immediate resistance level comes at 1.1450. Only a break above that, when we see a dollar index sliding, then there can be a possible test of 1.1640 also. But initially 1.1450 remains a very important resistance zone. Let's move on to the other central bank, that is the Bank of England. The Bank of England remains status quo in this policy with 5%, but they had cut their rates earlier in the month of July or August. Moving now, what are their anticipation is the inflation number still remains above the higher levels of 2%. So their inflation figure was at 2.2%. And particularly if we talk about the services inflation, that has been very hot to the tune of 5.6% versus 5.2% which was seen in July. Now this inflation remains a major concern, that is the services inflation, because it contributes almost to 80% to the British economy. So this remains under TAD, and they always follow a meeting by meeting approach. That's what we have understood historically, and thus jumping the guns to a rate cut may not be on cards at this point in time. And if we draw this into what we expect for the GBP USD pair, the GBP USD pair 1.2680 remains a very, very important support, while we are around at 1.33 mark. If we go to the Brexit levels, 1.3660 remains a very important resistance. Also, one more highlight which is very important to understand is they had the recent elections, thus the budget will be announced in the month of October, which can have some fiscal changes, in turn affecting the currency pair. Let's move on to Japanese yen, that is the dollar JPY pair or the Bank of Japan. The Bank of Japan kept its policy steady at this September policy with 0.15% to 0.25%. So that was steady, but they have seen a lot of shift. So they already had 2 hikes this year. In fact, since a decadal negative interest rates, they have moved on to the positive interest rates. But now, because they are anticipating to observe what kind of impact this positive interest rates may have, that is crucial to watch, and what kind of future trajectory in terms of growth and inflation will trigger, will be keeping the rates on hold at least till December. But we have seen this unwinding happening when the rates cycle got higher. Similarly, in case Bank of Japan Governor Ueda has been of the opinion that they are still fine with going for one more rate hike, in case if inflation falls to their 2% trajectory mark, and also the growth forecasts are in line in the central bank's projections, then they are okay for one more rate hike. We personally anticipate there is a possibility of rate hike in December, where we anticipate that if this happens, further unwinding can happen. Thus, the range for the dollar JPY pair can be a bit wide for us, where we anticipate 135.50 acting as an immediate support, while 152.5 acting as a resistance. But if we broaden the wings and if we see the impact of unwinding, if we are able to breach that 135.5, then we are able to see 132.20 mark. While on the other hand, 155.5 remains a very important resistance. So that remains a broader range for the dollar JPY pair. Now let's move on to the Brent crude prices, because we have seen a lot of volatility into the Brent crude prices and its impact on the macros of several economies considering India. So we have seen Brent crude prices in July to the tune of $88 per barrel, which was basis on the demand which was there into the market because of the summer driving festive season, and also because there was Middle East crisis. The escalation was there higher at that point in time. But after that, the Brent crude prices cooled off sharply, almost to 33-month low, or we can say more than 15% drop in the Brent crude prices was seen to the tune of $69 per barrel. Now this drop has been anticipated to several other reasons as well, where the OPEC had the global output demand forecast. They had lowered that for the year of 24-25. Also, there has been a slowdown in China, which has been consistently being fragile. So that remains another concern. And also the deal which happened in Libya had some kind of anticipation of oversupply of oil. So these were the reasons which pushed the oil prices lower, but then we have bounced back from those levels. Our anticipation for Brent crude prices from here on are to observe 3 factors. One, how the escalation of the Middle East crisis pan from here. Second, from the Fed rate cuts, how the US growth takes place. And third, importantly, how the Chinese economy grows from here. So these 3 important parameters will be watched out. The levels to watch out as per the technical charts remain $64.75 per barrel, acts as a very important support, while on the other hand, the toppish $90 per barrel continues to act as a very strong barometer to break. Now, we are here to talk about the most important topic to the interest of everyone, that is dollar rupee. First, I will say the range which the anticipation is for Shinhan Bank, that's 82.80 remains an important support zone, while 84 big figure first acts as an important resistance. If we see a break, then the NDF highs of 84.15 may be tested, followed by 84 halves. Now, what do we suggest for an importer as well as an exporter? For an importer, we have seen a decent slowdown into the spot market moving left. Now, this acts into the favor of an importer, though we have also seen on the other hand, because of the interest rate cut by the Fed, the interest rate differential between India and the US has widened. Thus, we have seen the forward premiums growing higher. Almost, if we talk about a 1-year annualized forward premium, it has grown from 1.6% to nearly 2.4% now. But because the spot has moved lower, almost by 40 to 50 paisa, which acts into the favor of the importer. So our suggestion is, considering the band of 83.40 to 83.50 zone, which is the current zone which we are witnessing, an importer should hedge 40% of their exposure at the current levels. On the other hand, if we are seeing a break or testing of levels around 83.20, further 30% can be added there. So almost 70% of hedging between 83.20 and 83 half levels, we can say. while a mental stop of 84 should be there with a 30% open position. What do we suggest an exporter? An exporter for us, one, as we already discussed, that there is a benefit of a rising forward premium, and we anticipate this forward premium can further rise from here, so that acts into their favor. If we are able to see levels of 83, 70, 80 zone, that should be the first trigger point to hedge at least 30 to 40% of our exposure there. While if we are able to test once again these 84 levels, another 30% should be hedged around those levels. A final mental stop should be around 83.20. That should act as an important support, where in case if we are able to breach those levels, then remaining 30% should be hedged. Rather, if not, then it should be kept open for the tenor. So we have seen historically, if we talk about the 25-year data, we have seen an average CAGR depreciation of dollar rupee to the extent of around 4.25%. While obviously this depreciation may narrow now because of the interest rate differential being narrow as compared to what it was in the past 25 years, but still slow steady depreciation will be seen in dollar rupee as well. So our take is the broader band for dollar rupee continues to remain 80 to 80 and 84 half. Well, that's all from my side, friends. I hope as usual and as always you find our videos valuable and find a lot of insights from it. Thank you so much. Once again, I am your host Kunal Sodhani, representing Global Trading Center, Shinhan Bank India. Thank you.